Hey guys, today's question comes from James in Jersey City, New Jersey. James asks, I invested in a Ponzi scheme. Looks like I'll end up losing about $300,000. Ouch. How do I treat this for tax purposes? Hey James, thanks so much for reaching out and submitting your question through our website, askacpa.co. Unfortunately, when the market begins to turn, many of these Ponzi schemes begin to collapse, leaving investors to deal with the aftermath. Fortunately for you, it's not all bad news from a tax perspective. So first, let's take a look at what exactly is a Ponzi scheme. So a Ponzi scheme is an investment scheme that lures in investors with promises of strong returns and little risk. The scammer uses new investors' funds to pay the fake returns to the original investors. When the pool of new investors dries up, the scam is typically exposed and leaves investors with huge losses. The most infamous Ponzi scheme was run by a guy named Bernie Madoff, who raised over $50 billion over 17 years from over 4,800 investors. His Ponzi scheme was exposed in 2008 when the financial market crashed, leaving many of his investors broke. Bernie was sentenced to 150 years in prison in 2009 and died in prison in 2021. Since then, the IRS has created a safe harbor rule, which automatically allows victims of Ponzi schemes thefts to claim these losses as a deduction. Under this new rule, the IRS will deem the loss to be the result of a theft if you meet one of the following criteria. So first, the Ponzi scheme's promoter was charged under state or federal law with fraud, embezzlement, or a similar crime, or the promoter was the subject of a state or federal criminal complaint alleging commission of such crime, and three, and finally, either there was some evidence or an admission of guilt by the promoter or a trustee was appointed to freeze the assets of the scheme. Now let's look at the tax relief options. So after the Bernie Madoff blow-up in 2018, Congress enacted some special tax rules for the victims of Ponzi schemes. Before these new regulations, the only option for victims had was to treat the losses as a capital loss from an investment. Unfortunately, capital losses are limited to a maximum of $3,000 per year. New regulations enacted in 2009 allow victims of Ponzi schemes to deduct these losses as a theft loss. Now this is under Rev Rule 2009-9. Theft losses are treated as an itemized deduction, which are reported on your individual tax return on Schedule A. Theft losses are typically limited to a $100 floor or 10% of your AGI, but Ponzi scheme losses are exempt from these limitations. So when do you claim the loss from a Ponzi scheme? So Ponzi scheme losses are deducted in the year in which the losses are discovered. The loss is limited to the amount invested, less any amounts returned or withdrawn, and any claims which are reasonably expected to be returned. If the loss deduction creates a net operating loss on your personal tax return, the NOL can be carried back 3 years or forward 20 years. So for more information, see Rev Rule 2009-9 and IRS Rev Proc 2009-20. Thanks again for the question, James. James asked his question through our website, askacpa.co. If you have a similar question, head over to our website and submit your question online or leave a question in the comments down below. If you found this video helpful, please make sure to subscribe and leave a thumbs up, and we really appreciate it. We'll see you on the next video. Take care.